Good afternoon and welcome everyone to what I suppose is new ground for Citadel as we get the opportunity to present our first live financial results webinar to you in the comfort of your own homes and offices. What I would like to do this afternoon is to give you an overview of how the company has been doing over the past financial year, how we're faring under COVID, what changes we envisage COVID will drive in our business, as well as also wanting to spend some time highlighting certain key developments within the Peregrine Group and what that means for us as a business. Our Chief Investment Officer, George Herman, is joining me for the discussion. Welcome, George. Thank you for joining us. And George will be talking later, when I've finished the company update, on the markets and answering any investment-related questions that you might have. But first, I'd like to start by looking at the past financial year. Now, I think we'd all agree that COVID aside, the past year in and of itself was particularly challenging from a South African perspective, let alone having to navigate the global headwinds brought by the worldwide political and economic uncertainty. I'm, however, pleased to report that despite these conditions, Citadel managed to deliver another set of solid results. I believe that in part, it's our value proposition and positioning of our business to being an advice-led wealth management business that comes to the fore in times like we are experiencing, and that allows us to be somewhat counter-cyclical to our peers in sector. At times like these, investors seek holistic advice, coupled with safe haven investment opportunities. And I believe it's through us delivering on these two investor requirements that has resulted in the overall poor economic environment having had less of an effect on our business, as well as any of the other local businesses in the Peregrine Group. Since our inception in 1993, there have been many financial crises. And one thing that history has taught us is that we will come out at the other end. I'm proud to say that through adversity, we as a business have gained strength, or as they also say, we've never wasted a good crisis. Now, a lot of this has to do with the four investment pillars that guide our investment philosophy. George, won't you just briefly take us through those, please?
Our investment philosophy guides how we manage the funds our clients entrust to us. This philosophy does indeed rest on four pillars. Firstly, the future will surprise. And wasn't 2020 just a perfect example of that? Secondly, diversification is essential. No concentrated bets in any solution. Thirdly, asset valuations are important. We try to avoid expensive assets with headwinds. And finally, asset allocation and wealth planning drives the long-term investment outcome for investors. All our investment processes rest on these four pillars. But as a company, Citadel also doesn't operate with blinkers on. We recognize that the responsibility that corporate South Africa has to make meaningful difference in our societies. Andrew, I know that sustainable giving is an issue that's very close to your heart.
Yes, it is something that I feel is very important and needs to be part of the DNA of Citadel, and for that matter, every South African business, and which is why I have taken a particular personal interest in Citadel's philanthropy division, which is headed up by Jean de Villiers, and which I believe is making exactly the sort of difference in society that we need to encourage. In November last year, we raised 1.4 million during the night with the Ronan Keating charity auction, where funds raised went to the Red Cross Memorial Children's Hospital to rebuild their oncology unit. And I must say, it really was an amazing event. It was only our second year of hosting this initiative, and anyone who has had a close-up encounter with serious childhood illness will certainly understand our enthusiasm for wanting to get involved and make a difference in this space. As I said, it was only our second year of involvement, and at the same event the previous year, we managed to raise R1 million on the night. This is a huge testament to the generosity of our wider Citadel family. Earlier this year, we also donated R1 million through the Khaleesi Foundation to Pink Drive in order to facilitate COVID-19 testing. But it really goes beyond that sort of giving, George. This approach starts internally, where within the business itself, we really strive to foster a culture of care. And in other words, really just simply recognizing that we have both internal and external clients. And where does a business get that without this dedicated group of 460 people who call themselves Citadelians, we will not be able to deliver the industry-leading service that we are able to our 8,900 clients? But just turning to see how all of this actually translated into some hard numbers, I'm pleased to say that Citadel actually finished the last financial year with a number of record metrics. We had gross inflows of 9.3 billion compared to 5.7 billion in the previous year. And if you unpack this number out, it was made up of 6.5 billion from our core business of private client inflows. 1.1 billion was as a result of the Purpose Wealth acquisition. 750 million came from the transfer of the takeover of the Stenham Trust and wealth management assets. 844 were inflows into our income portfolio, and 114 million flow into our EB portfolios, which is part of our new initiative. The point that I'm trying to make is that this number of 9.3 billion really was the fruition of a combination of number of strategies and the weatherproofing of our inflows that we've been working on over the past 18 months. Our outflows were very marginally up by 300 million from 3.9 billion to 4.2 billion, but they still remain very low as a percentage of our overall book. Again, in unpacking this number, it's pleasing to see that the mandate cancellations as a component of outflows were significantly down, and hence our uptick in client retention stats, which I'll touch on later. The normal scheduled and unscheduled withdrawals were also proportionately down, and I believe it's the efforts that we've had that have been successful in the onboarding of a younger client profile and demographic, due to the fact that these clients have a less of a requirement for monthly withdrawals and cash flows, that this change in client mix is having a overall positive impact on our business's net outflows. There was a continual widening of what we like to call internally the jaws of the crocodile, which is nothing more than comparison of the growth in revenue to the growth in costs. Our revenue grew at 14% to 1.13 billion. And while costs grew at a lower 12%, this correlation is typical for a business that is structured like ours due to, for example, our high costs of new business, amongst other things. So any growth in revenue will normally always be coupled with an accompanied growth in expenses and costs. We finished the year with a core margin of 65 bits, and just to give context to that number, in 2017, that number was 55. So a very solid improvement there over the last 3 years. Our performance fees were not unexpectedly slightly down. In 2019, we finished the year on performance fees of 42 million, and this year we ended with performance fees of 37 million. So as I said, slightly down, but given market conditions, not at all unexpected, and very grateful for them. Once again, whilst not unexpected, assets under management amounted to 57.2 billion compared to 51.2 billion in March 2019. As of today, that number now stands in excess of 61.3 billion, which I think, given the past while, bears testimony to the resilience of our investment solutions and our strategies. But lastly, and by far the most important metric for us as a business, in which we take probably the most pride in, is that of our client retention number. I'm grateful to say that we increased our client retention from 97% to just over 98% in the past financial year. And this, I believe, is us being able to maintain our strong focus on delivering a deeply personalized client service offering, combined with the strong performance of Citadel's in-house funds. So pulling this all together, the mentioned numbers combined, I believe, with the success of our vertical integration initiatives, our cost controls that we have in place, continuing to place the business in a strong, sustainable position, and have resulted in our attributable earnings over the past financial year increasing by 11% to 259 million.
Andrew, I just want to add that is no mean feat, considering that the economy was under pressure. We're already in a recession and there's a lot of uncertainty around. We also have to deal with one of the most volatile currencies in the world. So bearing all that in mind, and since you are the man in the hot seat, where do you see the Citadel growth strategy going from here?
Well, we're currently actively searching for potential acquisitions in the wealth management space. We are open to deals that add value, that allow the group to unlock the synergies and gear off the benefits of an already very strong vertically integrated business. And I suppose you could say we're browsing, but are in the fortunate position that we are not forced to or needing to do any acquisitions. So only quality would really entice us to make another acquisition and transaction. I believe a great example of our approach is the 49% stake that we've just recently acquired in Seshego Benefit Consulting. This transaction will see the synergies between both of our companies leveraged as we bring very strong individual and corporate advice under a single roof. Seshego was identified as the best fit in the corporate benefits advice space, and we are confident that this transaction will greatly enhance our overall new ventures into corporate solution offerings and industry insights through our own existing asset management division. For those who don't know Seshego, the business was established in 2005 and is well renowned for its corporate advice on benefits, investments, and risk management.
And they also bring some great people to the business.
Yes, absolutely. I mean, some of the best outcomes that we've had from previous acquisitions is the actual quality, skill set, and experience of the teams that we've actually acquired and that have come across to join our own people.
Indeed. And then, Andrew, turning to our people and how we work, it's impossible not to talk about the COVID-19 pandemic these days, but we made a quick decision to enable our staff to work from home. There really has been very little impact on our day-to-day operations. What's our plans in this regard?
Yes, I mean, that was a very interesting stat and development for us in terms of our operations, as you say, have been very lightly impacted, if at all, which is very pleasing. But for now, our work from home policy remains in place and is probably likely to do so for a while, George. As management, we obviously monitor this on a monthly basis. We've conducted extensive surveys within our employee base across all the regions, and the feedback has been very valuable in helping us craft a strategy with regards to going forward with issues like our office space and the contentness of the staff to actually work from home and what their own priorities are. One of our focuses going forward is going to be on new systems that are designed to streamline workflows and increase effectiveness. As always, the ultimate aim is going to be to create additional layers of value for our clients. And this focus on technology will, I believe, have the added benefit of ultimately reducing costs and ensuring far better and more effective to the point client service. At the beginning of May, we launched a new website. And at the beginning of June, we launched our secure client platform. Now, my Secure Zone, being both platforms, have been built using the latest technology, and they really make the user experience much easier, faster, and simpler. Of course, we always need to be incredibly mindful at the moment that the full impact of the COVID-19 pandemic is still an extreme unknown. We need to be alive to and be flexible enough to deal with shifts and to ensure our systems are strong. So the primary objectives of the Citadel business over the next 12 months will very simply be twofold: to guide and support clients effectively through this challenging and uncertain period, and to continue to provide a safe, solid, and reliable haven for our employees and clients alike. We will continue our focus of increasing our market share in the ultra-high net worth space in Southern Africa and abroad. And as part of this focus, we have run 2 new advertising campaigns between February and May this year. The brand awareness that we've received from these has been incredibly positive, and we're currently planning another advertising campaign for later this year. Call it a post or life after COVID campaign. Last month, I hosted a virtual chat with Gary Player, and Gary mentioned, just to quote him, that as you grow older, your views on the world change, that the opinions and what you stood for as a young person will likely not be the same when you reach your later years in life. And I think this very much speaks to life stages. And I believe our business is now ready to take a step forward into its own next stage, life stage, so to speak. We've recorded remarkable growth since its founding years, and I believe it's time for a new chapter for Citadel now.
There's some specific developments around that new chapter which are unfolding as we speak.
Yes, indeed they are. It's a daily update, if I can put it like that. But as has been widely reported and communicated by us, the Peregrine Group is under offer from a consortium of investors that includes, I'm happy to say, Citadel Management. The transaction, when completed, will see a delisting of the Peregrine Group from the Johannesburg Stock Exchange. Now, this is quite a move for a company that listed on the JSE in 1998 and grew into a mid-cap financial services group with gross total assets under management and advice of more than 140 billion as at the 31st of March 2020. So you may well ask, why now? And why is this the best strategy for the Peregrine Group? Well, I think in answering that, first and foremost, you've got to have a look at that 2018 and the 2019 financial years were significant determining factors, which resulted in a change for the strategy for Peregrine as it turned its attention to be focused more intently on what I would call an annuity income business, of which Citadel was and still is now the major component. In 2018, you may recall that Peregrine spun off its private equity and on balance sheet interest into Sandown Capital, which was very quickly followed in the 2019 financial year with Peregrine completing the sale of its broking business, Peregrine Securities, to Lechai. Now, while the transactions were well received by the market, it actually did little to unlock the significant value that we felt remained in the group. As an example, when we released our results last June, our share price was trading at an almost 30% discount to broker target prices and significantly less than our own internal values. So this had other implications for Peregrine and Citadel. The group was now significantly smaller, but as a listed company, it retained the same head office and cost structures as it had done prior to these transactions. The reduced market value for Peregrine made it a target for acquisitions from much larger financial services players, and it threatened our fiercely guarded independence. And I can't overstate this enough. It was this independence that we believe that sets us apart from our competitors and allows us to put our clients first. So Citadel, by default, as a consequence of all these changes, became the largest contributor to the group by some distance. But this wasn't yet reflected in the shareholding and the corporate governance structures of the group. And as you know, Citadel's strength lies in its people. And to ensure that our people and shareholders were aligned, we have always intended for a greater shareholding and management control of our very own business. So to address these issues, we went in search of a partner who could provide us the funding and autonomy to make the necessary changes. After 18 months of deliberations, we selected Capital Works, which is a private equity business based in Johannesburg, as our potential partner. And these guys, apart from having had significant experience in management buyouts in South Africa, as well as the ability to fund such a transaction, Capital Works stood out during our negotiations for, simply what I can say is their humility. And I say this because they essentially provided Citadel Management with operational autonomy, complete operational autonomy over Citadel going forward, as well as strategic and management involvement at a Peregrine Group level.
Thanks, Andrew. And now a question from a client is coming through, and he's asking exactly how will this work? Can you give us any further detail?
Sure. So from a structure point of view, I can tell you that the offer will be affected by two separate special purpose vehicles, Bidco and Invesco, which will be owned by a significant portion of Citadel's management and advice partners, Capital Works, as well as all current Peregrine shareholders who have been given the opportunity via the scheme of arrangement to accept the cash offer or to reinvest with an Invesco. Now, those of you are familiar with the group structure, this definitely includes Möller, Peregrine's BEE shareholder as well. Citadel Management will also take a 26% stake in the Peregrine Group, including a 15% stake in Citadel. And a shareholder circular will be released shortly that will provide further details around these exact points. Now, while the transaction will change the shareholding structure of Peregrine and remove the significant cost structure that supported the stock exchange listing, there will be no impact on the day-to-day running of the underlying Peregrine businesses. least ourselves, obviously including Citadel. I mean, if anything, the transaction, I believe, will provide the underlying businesses with further autonomy, flexibility, and independence to continue focusing on the value proposition that we seek to provide our clients. We certainly don't envisage any changes to our advisor force or the way that we operate in the future. So, just to backtrack to the client who asked this question, please be assured that our advisors are more aligned to Citadel and to providing you with our clients with the market-leading service that you have become accustomed to. We do expect the transaction to become effective in October once all the regulatory hurdles have been completed. And while these positive changes play out, I assure you that the Citadel team remains fully committed and focused on our core role, which is simply looking after our clients' financial wealth and giving them peace of mind about their financial future.
Another question that came through is, what will the shareholding of Capital Works be?
Well, if one follows the process, this is still to be determined and will only be able to be known at the shareholder meeting in September, where shareholders elect whether they want to remain invested or not. At this stage, what I can say, George, is that Capital Works could acquire up to 57% in the Peregrine Group, with this being less than 50% as well, depending on shareholder elections. Obviously, we'll be able to share the exact details once we have them.
Well, Andrew, you're being very forthright, so let's stick to that. I mean, how can we be sure that Capital Works will not negatively change the way Citadel operates by just focusing on their own returns?
Yes, no, I mean that's a fair question. One you can imagine that we've certainly looked at from every possible angle. Firstly, Citadel management will have more board representation and input and oversight of the group at the BidCo level. And we'll be retaining operational control of Citadel. We've also, negotiated significant minority protections, including a number of specifically protected matters that would require our approval, including mergers and acquisitions, changes to distribution policies, remuneration policies, raising of further debt, and so forth. So, I can stress again that you certainly won't see an impact on the day-to-day running of the business or the way that we, from an operational point of view, run the business going forward.
Okay, and maybe if we stretch that a little bit longer, I mean, that's important for our clients. What's likely to change for us in the group in, let's say, the next 5 years?
Well, as a private equity investor, I think it's clear that Capital Works will obviously want to look to exit the transaction in the next 5 to 7 to 8 years, although it could obviously be longer depending on market conditions. At that point in time, we believe that we will then have the flexibility to allow management to acquire either an even larger stake in the business or to find another suitable partner to take us on the next stage of our journey. You can be sure, though, that nothing will change from a client-servant perspective, and we look forward to us being focused on the market-leading service that our clients are used to.
Another interesting question that came through from a client, Andrew, is about the leverage in this transaction. Are you comfortable with the levels of leverage?
No, I mean that again is one of the major questions, around a transaction like this. And yes, again, we've looked at this, long and close. We've taken, a lot of advices, and we're very comfortable with the leverage levels. Together with our advisors, we looked at this carefully, and we also undertook a variety of sensitive analysis, which, just simply reinforced our thinking that this was the right thing to do.
And then a last question that came through, and this links back to our work from home observation, is will our clients see the benefits from the reduction in their office costs?
Look, our focus is unwavering, and that we intend to continue providing our clients with significant value in terms of service and cost. We have a number of projects ongoing in the business to improve the way we service each and every one of our clients, and that does include access to new systems and the effective use of technology to support our business. You can be rest assured that we continually benchmark, in fact annually, our fee structures to the market to ensure that you as our clients will always receive an attractive value proposition from Citadel. Most importantly, however, I want to take this opportunity to reaffirm our commitment to every one of you streaming in and those who will watch this later. While these positive changes play out, the Citadel team remains fully committed and focused on looking after you and your family's financial wealth. Yes, things are tumultuous out there, and this is a strange time to be alive, let alone invested. But we are still your safe pair of hands, and your financial future remains our top priority. I'm going to hand you over to George now, but before I go, I really want to thank you for your time and for your questions. I'm obviously happy to answer any more questions that you may have about the financial results or Capital Works transactions. So please just give me a call or drop me an email. But until then, George, over to you for an update on the economy and markets.
Thank you for that very forthright report back on the results of our company, the health of our company, our strategy during COVID, and also how the future is going to pan out with some changes happening. So that's magnificent. Thank you very much. I am now going to share my screen to share some slides with you in running through the markets. As you know, doing the markets without pictures is pretty difficult. So let's get this cracking. I imagine you should be seeing my presentation now. And then I would like to invite you again on the Q&A button at either the bottom or the top of your screen, depending what type of device you're using. You're welcome to post any further questions to either Andrew or I, the markets or the economy, throw those to me, and anything around the business or the results, throw those to Andrew, and we'll handle those after my presentation. I'm going to take you through a whirlwind tour of the world very quickly, because to describe what's happening right now is encyclopedic, to say the least. But right now, my title for today is one question. We only have to answer one question right now. Which is it that leads the world right now? Main Street or Wall Street? We have a situation now where the difference between the interpretation as of the real economy, as it's known Wall Street, or Main Street rather, and that of the markets, Wall Street, there's an enormous gap between those, and the Economist front page captured that very aptly. So that is the question of the day, and that's the one that I'm going to tackle. I'm going to take you through both sides of the argument and then tell you how we think about it. So the actual economy is going through a unique period where we had an enormous shock to the system, which was brought about by a medical pandemic, which was handled with political responses that caused an economic shock, and one like we've never seen before. Both global supply and demand stopped at the same time, led to the most synchronous global recession ever seen in history. More than 90% of all countries in the world are in recession right now as we speak. We saw the largest and fastest change in economic fundamentals ever seen. I'll show you some of those, as well as some unprecedented changes to employment levels. And that's all in the past. Now, looking to the future, what we don't know is how consumers will behave and how consumption patterns will change after COVID. We'll still have to see. To show you some of the difficulty of modeling and understanding the global economy, this is the NOWCAST, which is the Fed in New York's effort of using short-term data to estimate US GDP. And here in this left-hand block, we're looking at second quarter GDP. In other words, the quarter we're in now, that'll end of June. And you can see that their estimation of the data by the end of May took us to a figure that suggested that second quarter GDP in the US would be down more than 35% for the quarter. Since then, we've had some improvements in retail numbers and in manufacturing numbers, which now puts that estimate at minus 19.7% for the second quarter GDP. The third quarter GDP estimates have moved from minus 37 to minus 2%. So what I want to highlight here is, firstly, well, the enormity of the numbers, to see the US economy contracting in a quarter by 20 and then the following quarter by 2. And the second point I want to bring to you is that that means that for 2020, the overall number will be negative. But and also to show you the volatility even of these estimates, how enormous these changes are. So there's nobody in the world that can give you an exact number right now, but fact of the matter is it's going to have a minus in front of it. This is just to highlight the synchronicity of the global slowdown. And in fact, this is manufacturing output numbers, PMI numbers as it's known, production manufacturing indices, and the entire world negative on these numbers. Only China that is already out there, because remember, they are leading the situation out. The next thing I want to highlight is the enormity of the numbers in an historical context. So this is US non-farm payrolls, and in 2008 we saw how the economy kind of cyclically slowed down, started shedding jobs, then turned around and started creating jobs again. And then we had a period for 10 years where the US economy consistently created jobs. Suddenly we run into this sudden shock scenario, and the economy in March sheds jobs for the first time in a decade. And then comes the April number, and just look at that, 20.5 million jobs lost in that period, and the unemployment number just shoots through the roof. Can you see how this number, just placed in context in history, it is an enormous change. Another way to look at it is to see the unemployment numbers for the past, since 1975, the unemployment numbers. And my computer is just hanging on me. If you'll bear with me for 1 second, I just want to keep on highlighting the enormity of this change. And there we go. And to show that the 4-week total of employment changes in all the last recessions, and that what we're experiencing right now is literally 10 times bigger than anything that we've seen since World War II. Here is the employment numbers and how employment was shed during the last few recessions. So if you look at 1990, it took the economy 2.5 years, 2.5 years to gain back all the jobs that was lost. In the 2001 recession, it took about 3.5 years, nearly 4 years for all the jobs to come back. And in 2007, it took 6 years for all the jobs to come back. So how long is this going to take? Well, it doesn't look too good from that perspective, but what we know is it's going to take some time. This is going all the way back to the post-World War era, and all the recessions highlighted in blue, and just to show the enormity of the current unemployment number. But that number is susceptible to change because the size of the population changed over such a long historic period. So what we do here is, and this is JP Morgan's numbers, is you look at the number of employed people in the US divided by the population to get a sense of the level of overall employment in the economy. And fact of the matter is that the economy grew nicely and created a lot of jobs all the way into the 2000 recession, started going backwards on that metric. In 2008, took a big smack lower, and look where we are now. This is the least amount of people proportionately in the US employed since the Second World War. There's no ways that you can just ignore that number and say, don't worry, we'll look through this. So let's look at it a little bit closer in terms of the impact of unemployment on earnings in companies in the US. Here's all the different sectors. And now you have to pick your number of unemployment. We're currently at 13.3. But let's just be nice and say in the next couple of months, few of those jobs come back and we get to -10. But look at the impact on earnings of all these industries with that type of unemployment number. I mean, we know that airlines and hotels and publishing and media and restaurants take a big knock. I mean, that's everything between -85 and -20 on earnings. And then it goes all the way down to food producers on 10. And the only things on the other side of this, financials and technology, may be slightly positive, but it doesn't offset all of this. These are truly enormous numbers. And then we have to bear in mind that the credit cycle runs behind the economic cycle. So the credit distress that follows from this economic shock must still come through the system. So this is the default rate on speculative grade paper in the US at the moment, running at about 3%, which is pretty standard and normal. Now, under a very optimistic case, that number needs to double to 6%, and the base case forecast in this instance by S&P takes that number to 12%. a lot of credit pain must still work through the system. So how long is it going to take, and what would the speed of this recovery be? Now, obviously, consumers, personal consumption expenditure, they come back very quickly the moment that you open up the economy. Take your personal example. The moment the lockup opened, you rushed out, you had a ton of stuff to buy that you were looking to buy. So retail, the consumption expenditure comes back pretty quickly, but you see it flattens off. It doesn't come back to 100% even by the end of 2021. Employment will also bounce back in line with that, but even that only pulls back to 92.5% of where we were end of 2019 at the end of 2021. So after 2 years, you're not even back to where you were. But the problem is that even to do that, a post-COVID scenario, many changes need to be made in how we do business, how our offices are structured. Social distancing requires a lot of costs. A lot of people are still laid off, and hence the profitability on companies are affected by that. And you can see that profit generation, earnings generation ability of companies, even by the end of 2021, even then is only at 80% of where we were in the back end of 2019. So it will take some time for all of this to work through the system. This goes back to the credit slide, and it just shows you how insolvencies literally just jumped last month, and it is now the highest that it was since May 2009, just to highlight the point that the credit pain must still work through the system. And so here's the first half of my one question to you in terms of which is the one that reflects the world more accurately right now, Wall Street or Main Street. And so I've shown you everything from Main Street, the real economy, and this is what truly happened to earnings for all S&P companies. And you can see that in 2008, earnings dropped by 40%. And by all measurements, what our economy experienced now is even worse than what we had in 2008. But for now, because those numbers haven't been reported yet, earnings only down 28-29% at this point in time. So there's probably more to come as the second quarter earnings get reported into July, August. And so just to make the point that this is the reality, earnings decline when an economy goes into recession. So let's look at how the markets view the situation. How does Wall Street view the situation? Well, right now you can summarize whatever Wall Street says and does by one thing only: central banks, liquidity, central banks standing behind the markets. In fact, this is just to show you the expansion of the Fed balance sheet via quantitative easing programs. After 2008, we saw the first use of QE, and the QE at that time was 1.4 trillion, which equated to about 9% of the US GDP. QE2 was much smaller in 2011, and after the taper tantrum in 2013, we saw QE3, which was 1.7 trillion, which equated to 8% of GDP. What we've seen this year, thus far, and what is projected forward to the end of 2021 is $6.2 trillion, which equates to approximately 30% of US GDP, and takes the Fed's balance sheet, increases the size to more than $10 trillion. Remember, it was at less than $1 trillion in 2008. So in 12 years, this has gone up more than tenfold. That's the amount of new debt that's been created to paper over this problem. But the market sees this astonishing number of 30% of GDP being added to the system to help the market through this tough period. And no surprise that we have, after the fastest drop into a bear market, where the market dropped by 34%, this is the S&P that we're looking at in the US, the market didn't waste any time and literally in 2 months bounced back 41%, nearly in a straight line. You can see how volatility increased as shown by daily moves here at the bottom. And then to take that one step further, obviously technology stocks gain from all of this. The NASDAQ celebrated even more, and in fact is now at a new all-time record high. But it wasn't only, and that jumped 47% from its bottom in straight line, as you can see. But it wasn't only equities that benefited from this. This is US corporate bond yields expressed as spreads over treasuries. And just to show that once the Fed indicated, well, they're going to buy more than just bonds, they'll start buying corporate government bonds, they'll start buying corporate bonds as well. You can see during the stress how the spread nearly doubled or more than doubled from 2.25 to 4.5. And on the Fed's announcement came all the way back and is in fact now lower than before. I mean, this market suggests that the world is healthier from an economic perspective today than it was at the end of 2019, or in fact, any time before that. I don't want to put an opinion on this, but I would suggest this is lunacy. And so all prophecies of doom and gloom that went along with COVID is now absolutely gone after the Fed promised to do whatever it takes. And so it feels like the Fed has created a put option below the market that created a floor under stocks. And following that 2008 recession, they did that. But now it has become a put on everything, creating floors under absolutely everything. And so the saying in the market now goes, don't fight the Fed. And so if you combine that don't fight the Fed with FOMO, the fear of missing out, you get this absolute rocket ride that we're currently experiencing. Not my words, those of the RMB group in the US. And to highlight now the impact of that, this is the S&P index, that sharp drop, the straight V recovery in the market, not in the economy. You now have valuations. This is the PE ratio. And yes, it is a very rudimentary, basic, one-dimensional descriptor of value of an equity. So all your equity analysts out there, you want to come and run with all 300, your other metrics, perfect, we can do that. But we have to show one visible metric with a long history that does take all of this into account, this specific question of Main Street, Wall Street, the price versus the earnings, and it makes the S&P index the most expensive it has been since the year 2000. The only way for this line to come down is for the markets to trade lower or for earnings to come racing upwards. And then we compare this bull move that we've seen since the 23rd of March to other bull markets that we've seen post-war. There was 12 major bull markets. These are 8 different characteristics that you typically see during bull markets. And in any bull market where you have a really strong bull market, it would qualify for every one of these metrics. And so all the bull markets we've had between 5 and 8 of these characteristics were present during that bull market. This current move from the 23rd of March to now has not met a single one of these characteristics of a sustainable bull market. So it will be a unique one if this extends. We've also had a speculative surge to absolute stunning levels. We've seen new speculative traders come to the market as retail investors who got a lot of support money from the US government has just swarmed into the market. We've literally had a retail swarm, and they've done some interesting things, one of them being buying insolvent companies. We had the unique scenario where Hertz was declared insolvent, and then after that, their stock price rallied by 825%, in fact, forcing them to reopen their business again, to issue equity into that run, just afterwards to go back into liquidation. It would go down in history as one of the most peculiar events ever seen in the financial markets. This also shows the volume on the NASDAQ stock exchange, and you now have a new record high on the NASDAQ combined with a new record high of volume. That is always somewhat bewildering. And so the best summary I have for you to make this picture is that you can look at that house from 2 different angles. It's quite clear that the stock market or Wall Street views it from one angle, and that Main Street or the economists view it from a different angle. We'll see how that pans out. If that doesn't appeal to you, here's the quantitative research that goes with it. Down here, you have macroeconomic fundamentals in the US, and those are run against the level of the S&P index, and this has been done since 2008. And this has a 97% correlation, meaning that these two run very closely together. When we were at the end of 2019, it seemed like the market was somewhat higher than what the fundamentals of the economy was suggesting at that point in time. In March, the market pulled back to exactly equilibrium in terms of this analysis. In April and May, it extended again because remember, the economic fundamentals are deteriorating, but the market went higher This is where we are sitting right now. This is the largest divergence between actual underlying macroeconomic fundamentals and the level of the S&P in history. Now, that's all the economics, and now you get to the next factor. We have to run into a US election in November as well. So since Mr. Biden was announced as the Democrat representative, his ratings have increased, and he was fortunate he didn't have to do much, because Mr. Trump shot himself in the foot with his handling of COVID, and then more recently with the George Floyd scenario, haven't made any more friends either. And so now things have swung around dramatically. And as the polls stand right now, Mr. Trump is trailing by a long way. And as we know, when he's trailing, he's going to throw the kitchen sink at this. So who knows what happens in the next 5 months. It promises to be interesting. This is like watching a rugby match between England and Australia where you wish both could lose. This election is the same one. Yeah, good luck, the US. And then again, jokes aside, how do we assess what to do in these markets? Well, the market sentiment right now suggests that because economies are reopening, that they're magically just going to grow, and that COVID is over and infections are right down, and the Fed is just liquidating everything, so don't worry. There's a lot of fiscal support, and that the market right now is interpreting good news as great, and when there's bad news, well, then the Fed will do more, go back to step one, and this loop just reinforces itself. And so stocks are priced absolutely for perfection right now. Earnings have to jump, or in fact, the way they're priced right now, it suggests that earnings will jump straight back, and that by the end of 2021, earnings will be ahead of where we were in 2019, and that the economy will be back in terms of its capacity to where we were in 2019. We don't think that that is remotely possible, because social distancing squeezes capacity out of an economy. There's no ways that airplanes, restaurants, movies, anything can be as full as they were before. And so it's difficult to see how capacity can be at that same level. Our process is rooted in the economic cycle. We believe that the economy is the gravity to whatever happens to the stock market, and you can't get away from gravity. Earnings is derived from economics. We are currently in a huge global recession. Yes, it is improving, but we're still in a recession as we speak. There are many risks still out there, and COVID has caused natural deglobalization already, even before Mr. Trump has jumped back onto the US-China trade war situation. So we consider the valuation of the markets right now to be quite expensive, and our strategy typically is to reduce risk when markets are expensive, not hope for a jump in earnings. That's what the market's doing right now. We use a 3-year time horizon, and so yes, we would have a different view to consensus right now in the short term, but that is exactly what our analysis is supposed to do. And then diversification, by the way, doesn't mean buy everything. It means judiciously buying a specific combination of assets to reduce risk and optimize returns. Whereas this current situation of just buy anything and you'll be okay is going to lead to tears. Just to take an example, in December, only 6 months ago, the expectation for US GDP was to be at 2.3 for 2020, and that earnings growth would grow at 6. Right now, the GDP is probably going to print for 2020 minus 6%, and earnings are going to be minus 20% for the year, and I'm being kind here, yet the equity market's at the exact same level where it was at the end of 2019. So a market at the same place at 2 places with these fundamentals underlying, yeah, there's a debate to be made, and that is the 2 sides of it. So now I add to that graph that I showed you before, the black line is earnings, and this has only dropped 28, and as I indicated, we're still waiting for second quarter earnings numbers, but yet the market is just too impatient. It's already straight back to where it was, and this bifurcation, this difference between Wall Street and Main Street is the largest difference we've ever seen between these 2 metrics. If I stretch it back to post 2000, to before 2000, the largest difference we've ever seen was in 2000 when on this analysis, the market was 45% ahead of earnings here. We are exactly at that same point again. So just to highlight again, the largest divergence between Wall Street and Main Street in history. And that is the question of today. Do you back the economics? Is that real? Or is the market telling us where the world is going? We're not in that school. We believe that economics is the gravity that pulls things together. So we are quite cautious at this point in time. I have to touch on South Africa because there's so many things happening. I'm already on 23 minutes, so I have to move a little bit. But if you think you're having a tough day today, well, you're not having as tough a day as Mr. Mboweni will have at 3 o'clock this afternoon. These are the fundamentals that South Africa is facing. Our GDP is forecast to drop by as much as 14% for the second quarter, then by 10% for the third quarter, another 8% in the fourth quarter, and that comeback is real slow. So you can see that the average outlook now, consensus outlook for SA GDP is to drop by 7 this year and only recover very mildly into 21-22. Unemployment is our Achilles heel, and we are at record unemployment numbers. Those numbers came out yesterday. And then our budget deficit enormous, doubling to nearly 14% and staying double digits for quite some time to come. So Mr. Mboweni facing a tough challenge. Growth was already under pressure. If you look at growth all the way from the 1960s, it has been stepping down. We had the good noughties, and then literally over the last 10 years, the economy has been slowing, and we were in recession even before this horrific change happens. Our problem in South Africa is that productivity is too low. We're one of the lowest productivity countries in the world. And remember that your real GDP growth is driven by population growth and productivity growth, so super important. This just shows that our global competitiveness is too low, and we have to work on that. This is a study between the global competitive index on this axis versus your per capita income on this side, just showing that true wealth, true growth is generated by global competitiveness. And so we have to work on that. Our network industries, ports, rails, electricity, telecommunications, those need to be working and solid and not insolvent for our economy to have sustainable growth. No surprise that the South African Business Confidence Index is extremely low, the lowest it's ever been. This is a retail confidence index, and over the last 8-9 years have just been declining. So no surprise that Edgon in the situation that they are. The leading indicator from the SARB came out yesterday, and yes, it declined a lot, but on a month-on-month basis, it was the largest decline we've ever seen in the SARB's leading indicator. So the pain not nearly over for South Africa. And in fact, to have a little eye on 3 o'clock this afternoon, Mr. Mboweni is going to face revenues that are down anything between 250 and 400 billion rand. And on the other side, expenditure that's up anything between 100 and 150 billion rand. Now that's between a rock and a hard place. It's going to be important for the world to see how he talks about privatization and the bailing out of SOEs. He might push this out to the medium-term budget. The budget deficit, as I mentioned in that consensus table, was at minus 6.8 in the Feb budget. It's now going to go to more than double that, and it's going to stay double digits for a long time. Our borrowing requirements can increase by 350 billion rand approximately. That is 1 billion rand per day that needs to be borrowed additionally from what was needed before. You can't borrow yourself into success, so this is problematic. How's this going to be funded? Well, is it going to increase tax? It's going to come to the local bond market. It's going to go to the foreign bond market. Those have implications. When S&P didn't, or Moody's rather, didn't want to downgrade us when our debt was at 62, and that was only 3 months ago, debt to GDP at 62%. Well, we're now going to go through 100%, and we'll be at 115% on the medium term. And so we're going to look out for what growth-enhancing reforms Mr. Mboweni brings to us, and any issues around prescribed assets, once again, which he'll probably leave for the medium-term budget. So in summary, the South African economy is going through a tough period. It's going to take at least 3 years to make back the loss that we're suffering in economic growth in 2020. We're going to need structural reforms, and we are going to need public-private partnership, and the government's going to have to work hard in terms of getting this right. We are very dependent on a global risk-on, risk-off sentiment situation, so it's not all just about South Africa. For equity markets, we're going to need global growth and or commodities to go on a run. In the bond market, we're going to need fiscal discipline because the borrowing requirement is truly enormous. And our currency, well, that's going to be a balance between the global improvements and how fast they come back, and between our own South African domestic crisis that is looming. And we've been here before, and so taking the words of our wise old leader, it seems impossible right now, but it can be done. I thank you for that. And that is my whirlwind trip of the world to give you a sense of how we view the difference between Wall Street and Main Street. I'm now going to stop sharing my screen, and we're going to go over to Q&A if there are any.
Thanks, George. Thanks for that. I'll kick off. There's a question that's coming around our performance fees. And whilst in part, George, I'd like to ask you to answer it. The question is, correctly noted that our performance fees went down by 12% from the 2019 to the 2020 financial year. And, the question is, is there a very specific reason for this, or what it is? What I can say is that obviously it's the way, in part, that we calculate our performance fees. Always having to go back to inception and always having to pass the previous high water mark, would imply that in markets like we've been experiencing over the last 2 years, that your recalibration back to inception, would result in something like this. But George, do you have any specific comments around markets in those two specific periods?
Well, the first one would be that those numbers include the moves that we had in February and March. So a dramatic pull down in the markets. A second reason is that, number of clients on those mandates through time becomes less. So that's also a natural thing. And then thirdly, just to highlight, this doesn't refer to performance relative to benchmark, like in, let's say, an equity fund or a private equity fund or anything of that nature. That's not those type of performance fees. This is an absolute return thinking relative to inflation. And so financial market returns relative to inflation have reduced somewhat. So that naturally leads to that number reducing. That's not a reflection on performance numbers per se. Okay, let's see if there's any other questions. What is your view on process Naspers and multi-choice shares in the coming year? And how will Citadel handle these? Well, we think that it's far better to own Naspers than process. The discount inside Naspers is still enormous, so you still own the process shares inside there, or you get access to that. So it's a more efficient way of getting that. So we prefer holding Naspers over process. Multi-choice done great during the lockdown and whatever. But sometimes quite skeptical about that share's ability to grow. It's all an African story, and so it's not a large holding in our portfolios. Naspers, just to get back to that, it's following on whatever Tencent does. I mean, Tencent has been on an absolute tear over the last 6 days, new all-time record highs. As China's economy is bouncing back after COVID, the Tencent share follows that, and Naspers follows it. We were trading close to 3,200 yesterday. So the share in a healthy space as we stand, and we're still positive on Naspers. As you know, we have to trim back on Naspers because they are so enormous in the indices and you get too much concentration risk in your portfolios. Hold or sell Tesla. Now, my portfolio manager in global equities, Victor, is going to annihilate me about this because he loves Tesla because of its technology and that they are leading in battery technology, blah, blah, blah. And he can go on with this, and he's really excited about Tesla. In my world, I don't want to own it. I don't want to be close to it. And if I can short it, I will short it too. And if I was able to short it, I would have been bankrupt by now because the share is trading close to $900. The question whether it's a good company or a Ponzi scheme, the answer isn't quite clear on that. We're not fans of Tesla. We don't own Tesla. Even if Victor is very excited about it, There's too much risk in that share. The CEO is just not of the caliber that we would invest global money into. So it's not something that comes into your portfolio, which we refer to as global grades. You're never going to have a company called Tesla in there. Andrew, there's a question there. Should one delay your retirement plans?
I mean, certainly not, but based on the conditions alone on the market. I mean, I'd like to discuss that potentially in more detail with the client and their advisor, certainly. But no, I mean, our view is that there's nothing that we're seeing. We believe that our range of portfolios and solutions that we have are suitably designed and, you know, to deal with the current entry into the market. So certainly not.
I agree with that. And then the projected oil price going forward. Well, the oil markets had a unique situation where the amount of oil in storage is absolutely at an all-time high. In fact, global oil storage facilities are chock-a-block full. That kind of keeps a cap on oil prices. On the other hand, it depends on how fast the global economy rebounds. And that's the demand side of oil. It seems like oil price absolutely capped around $50 at this point in time. We're in the early 40s as we speak right now. So maybe a little bit of headroom as excitement and positive sentiment around the reopening of the world economy comes back. But we think that the upside for oil is pretty limited. And this adds to the picture that the global economy is kind of in a deflation scenario right now. There's not many pressures on inflation. Next question, what are the chances of South Africa getting out of this deep hole in terms of borrowing and growth prospects? Well, you know, there's a lot of things out there, and we can discuss that. Yesterday, we had the infrastructure shindig by the president. It was very positive. There's a lot of people that want to put money towards specific infrastructure investments and many other investments as long as governance is in place. The IMF negotiating $4.2 billion loan right now. The New Development Bank gave us a $1 billion loan. So there are sources of money out there. There's no reason to be negative about it right now. Also, we're not alone in this scenario. The whole world is in this. The whole emerging market space is in this. So we will get out of this. We're going to take a few punches in this process. I'm talking about the country, the economy, the fiscus, but we will get through this. And then where's the rand going? Oh, wow, there's the question. I think I touched on it, but I went through that very quickly, is that as the globe improves, as sentiment in the globe improves, immediately our currency is a proxy for emerging market exposure, and we see a lot of interest in our currency. We saw that earlier this year already, where after the initial sell-off through 19 on the currency, it very rapidly came back, along with other emerging markets, along with the South African Reserve Bank adding liquidity to our own bond market, and improved into the high 16s. It feels like it's an equilibrium right now, and it's waiting for the rest of the world to make its move. Considering our current fiscal scenario, the amount of debt that we have to raise, we will have to go to global bond markets to raise some of that. I can't see a long maturing bull market in the rand relative to the rest of the world. In other words, taking us into sub 15s. I battle to see that. Yes, there's a big school out there that thinks that the dollar must and will go weaker. And in that scenario, if the dollar goes weaker, commodities go stronger, you can see the rand improve. If the dollar does not materially weaken, I can't see the rand going materially stronger than going sub 17. In fact, I had 1650 as my year-end target, and I'll leave that as the positive case for now, but there's a good chance that we go a bit weaker than that, considering what Mr. Mboweni has to go through this afternoon. And if he puts a foot wrong on any policy issue, well, then the upside opens up. So a positive outlook with a major risk tail environment. Okay, I think that wraps it up. A whole bunch of questions. And Andrew, thank you very much once again for the in-depth insight into the dynamics of the business. I think it's important for our clients to know that our company is in a healthy and a good shape, and that our future plans for the group is absolutely revolved about making sure that the interests of the business and that of our clients are always aligned. And you've made that crystal clear, and we are all in this business committed to that objective. So ladies and gentlemen, with that, thank you very much. We really appreciate your time, and look forward to being in touch with you again soon. Bye-bye.